Speaking of which, want to bring in our Morgan Brennan with a very special guest here at Post 9 this morning. Hey, Morgan.
Hey, good morning, guys. And yes, we want to bring in the CEO and president of CSX, Joe Hinrichs. Joe, it's great to have you on the show.
Good morning, Morgan. Thanks for having me.
All right, so that's exactly where I want to start, because one of the things that's disappointing investors this morning is your 2025 outlook. And we don't always talk about it because it's not the big booming business it once was for the railroads, but it is still a sizable business, and it is one of your most profitable businesses, and that's coal. So how is coal factoring into your outlook? What are your expectations for that market in 2025?
Yeah, Morgan, coal is actually our second largest segment of our customer base after chemicals, and that's largely driven by export coal, which metallurgical coal is a big export product for the United States into places like India and Eastern Europe and Asia. And that volume on export coal grew 9% last year, even with the Francis Scott Key Bridge collapse, blocking our coal terminal for shipping for 9 or 7 weeks last year. The problem is actually not problem, but the challenge is our rates for export coal for our customers are tied to the pricing externally in the environment, and that pricing's come down, so our revenues come down with it, even though the volume is still growing on the export side.
Okay. Yesterday, we had President Trump at Davos, who was talking about, and we've seen it in general this week since he took office, many dozens of executive orders to unleash this, in part, energy renaissance here in the U.S. But yesterday at Davos, he even brings up coal as a possible fuel source to build out AI and power AI infrastructure. So how do you expect that to play out domestically? Is CSX positioned from an infrastructure standpoint to benefit from it?
Well, we could be. I mean, thermal coal, which is used for the utilities to generate power here in the United States, has been in decline. It was last year as well. There are some planned utility closures actually later this year. But when natural gas prices rise and there's more energy demand, there's more demand for thermal coal. Matter of fact, we're seeing that right now with our customers with the cold spell going through the United States, especially the southern part. Our customers are coming back asking for more coal because they're using more thermal coal. And as the natural gas prices rise, the cost-benefit relationship with coal changes. So there could be more demand for thermal coal this year. That's something we're looking at and possibly anticipating for the year.
Of course, we look at the other parts of your business. Merchandise basically came in line. Intermodal was stronger than expected. What are you seeing across the different types of goods that you're moving right now? How much of this, particularly on the intermodal side, was perhaps pull forward ahead of a possible port strike, which we know has since been resolved?
Yeah, there was some talk about possibly the intermodal business, especially the international side, coming in a little heavier because of the threat of the port strike on the east and also because of tariffs. We don't really see that volume moving as much related to that. We've talked to our customers. They believe there is still consumer demand out there. What we are seeing, though, overall, is the interest rate sensitive parts of the market, automotive, steel, housing, still under some pressure. You saw auto shipments were down last quarter. They're actually slow to start the year this year. Steel continues to be down. So we're looking for, obviously, interest rate improvement over time to help with that. But there is strength in several markets. Ag and food, chemicals have been up all year and continue to be strong. Forest products are up, pulp and paperboard, that kind of thing. So it's a mixed bag. Coal demand externally on the export side is strong as well. Love to see the interest rates come down to help auto and housing especially.
How are you gaming out trade policy this year and beyond? I mean, February 1st, we could potentially start to see more duties levied on goods coming across the borders from Mexico and Canada. There's also talk about some of these imports from China. You'll be on the front lines of any of those shifts that we see.
Yeah, sure. I mean, certainly on the international intermodal side, the things that come into the ports that could be affected by tariffs. We go back and look at the first Trump administration, though, there wasn't a dramatic change in imports from a volume standpoint, because currency and other cost adjustments took place in some respects. We'll see what happens, obviously, going forward. But if you think about it, if the U.S. economy starts growing more than it is today, especially the industrial part of the economy, it will benefit us and the railroads in general, because, we move a lot of the heavy goods and the materials that go into that. So we're optimistic that there are going to be policies in place that will help grow the economy of the United States, especially the industrial side, which has been pretty much flat to down over the last couple of years.